Today we're going to talk about Britain's best dividend stocks and how we identified them. And before we get into that, I wanted to talk nomenclature first. So the United Kingdom, or Britain, is comprised of four countries really: England, Scotland, Wales, and Northern Ireland. We're not going to get into why Ireland's not part of the UK. There's certainly a lot of political debate to be had around this whole notion of a United Kingdom, but today we're here to look at dividend growth stocks, and those largely come from England. That's because Wales and Scotland don't have proper stock exchanges. Now, I spent a fair amount of time in England studying and working. I studied in Manchester and I worked in London. This was my local, the White Horse in Parsons Green. And while studying in England, I learned just how different the business nomenclature could be. So that's something that we'll touch on today as we're going through our list of 5 dividend growth stocks from the United Kingdom. So when we look at the geographical region, the largest cities, it's no surprise that London has the stock exchange where all of today's stocks trade on. When you look at a list of the largest stock exchanges in the world by market cap, you can see that on the right here. In position number 9 is the LSE Group in the UK with $3.4 trillion in market cap. Now, one thing to note about the UK is that over the past couple of decades, they seem to be losing their status. So one way to measure that is by looking at the MSCI All Country World Index, which represents essentially the entire world. And you can see, of course, in top place there, the United States at, what, a 64% weighting, and you have Japan at around 5%, and the UK around 3.5%. That's down from 8% several decades ago. And you can also see this chart on the left, which shows liquidity. So the number of listed companies with average daily trading volumes over $1 million. And you can see that number represented for the US, Europe, ex-UK, and Japan. And then you see the UK along the bottom there. It's certainly hasn't grown. It looks like it's declined. So that's not good when you have declining liquidity, more or less usage of your exchange platform. So when we look at the largest stocks in the United Kingdom, so 10 stocks make up 50% of the iShares MSCI UK ETF, and those names are here. One of these firms we're going to talk about today. There are other dividend champions listed here as well, and the thing to note here is that the concentration here is quite high. So just 10 stocks make up over half of, or say nearly half of, the MSCI UK ETF. So if you were going to invest in the country, you would be overweight these names. Now, when it comes to global dividend champions, we recently produced the Quantigence International Dividend Champions Report. It identified 45 global champions, 26 were in Europe, 15 in the UK, and we laxed the threshold. So the traditional definition of a champion is a company that's not only paid a dividend but increased it for 25 years in a row at least. So we laxed that down to 20 to broaden our scope and to have more constituents. And when it comes to the UK, 15 of the stocks that we identified as champions in our list, they've increased dividends for 20 years or more, 13 of those for 25 years or more. So those would be traditional champions. 2 have increased for 40 years or more, but they don't have any dividend kings. Those would be firms that have increased for 50 years or more. So before we get into talking about the 5 names, please make sure to subscribe because we have some great videos coming out. We're going to do a piece on UK investment trust champions. So for paying subscribers who all have access to that Quantigence International Champions Report, we'll be doing an insert for that of UK investment trusts. I think there's 20 that we've shortlisted. We're going to be looking at Roths versus traditional IRAs, which is best. We're going to look at the safest way to invest in crypto, a complete guide to investing in AI, a piece on gold and why we hold it. So make sure to subscribe so you don't miss those pieces. And to support our work, we don't run ads, so we need your financial support. You can purchase reports. Those are available here on YouTube. Our International Champions Report is 30% off, or you can consider a Nanalyze Premium subscription and join thousands of happy subscribers. So let's get down to brass tacks here. The top 5 dividend growth stocks in the United Kingdom, you can see them here. We used this 7-factor approach to produce a Q-score. This data has all been manually put together since we haven't yet identified a provider that we're going to use. There isn't that big of a universe, so we just collected this data manually. And it wasn't easy. So here are the names. So we have Linde, RWS, Spectris, Unilever, and Bunzl. So a few names on here that might be familiar, Linde and Unilever. These others I wasn't familiar with. So when we look at the data used to produce their Q scores, you can see that here: international sales, yield, compound annual growth rates for dividends at 5-year, 10-year, payout ratio. I highlighted a couple numbers here of interest. So for Linde, they have a low yield, so you can see that their corresponding Q-score value for yield is negative. That means they've been penalized. Same thing with Unilever. So their 5-year dividend growth rate is only 2%. Well, that doesn't even beat inflation, so they need to be penalized for that. So you can see, consequently, their 5-year growth rate there is negative, -1. They've been penalized. So let's talk about these 5 firms, starting with Linde. This is the largest producer of industrial gases in the world. Here you can see their historical performance is quite notable. In particular, the 30-year compound annual growth rate for their dividends of 13%. That's great. Anything in the double digits is handily outpacing inflation. Of course, they have to grow earnings per share at the same rate so that they can increase their dividend. That references payout ratio, which is quite low for Linde. So it's a very strong performing company. When we look at how they grow earnings per share, management talks about this. Price, productivity, and cost management accounts for most of the earnings per share growth. And then capital allocation, so buying back shares, and then a macro ding there on foreign currencies. But for 5 years in a row, they've managed double-digit earnings per share growth despite the old macroeconomic headwinds. So quite a strong management team running this company. The second name on our list, RWS. So they basically do language translation work in various aspects of that. And you can see here the 35,000 in-house and freelance language specialists that they have, along with 100,000 strong community of annotators and validators. These are all people working to translate things for 88 of the top 100 brands, so some very strong clients in their list. They say this is a $47 billion market. And a couple of things we noted here. First, they talk about a long-standing experience and capability in AI. I think that's potentially a double-edged sword because AI stands to disrupt language translation, although we're going to touch on that a little bit later. They talk about their progressive dividend policy. This is a term we see lots of UK companies using in reference to increasing their dividends over time. And they talk about the ability to invest organically and consolidate a fragmented market, which brings us to their overall portfolio and what they do. So as I said, language services, what they call localization. So we used to work on this when I worked at Hewlett-Packard early in my career. We did localization testing. So they'd have a printer. You want to sell that printer in 30 countries? Well, guess what? You got to translate to 30 languages and everything needs to be correct. So that's where more technical translations can come into play. You see here they do that work as well for regulated industry. So when you're doing translations for life sciences or legal or something in finance, you got to make sure you get that stuff right. So you need specialized translators, people who are subject matter experts. That costs money, right? So they do that, and they also have this category, language and content technology. They talk about AI there. And then this IP services segment for patent translation and filing patents in different countries. Again, getting back to that need for subject matter experts. But what I think is worth questioning here, is this another Appen waiting to happen? So we used to be invested in Appen, and then I exited our position quite a while ago because we didn't think they were properly preparing for what would happen when AI arrived on the scene. So what we see here with RWS, in particular, their high yield and declining revenue growth, there are some concerns there. And they did this presentation talking about how they're going to wield AI and do all this great stuff. And this is probably worth another look. But I think we know why their yield is so strong. It's because the market doesn't think they can keep up that 20-year streak. So it would be a firm, I think, that needs more due diligence. Then we have Spectris. So they do boring stuff like scientific measurement and virtual and physical testing. They're expanding through M&A. Their last dividend raise of 5% was rather mediocre, but they have strong industry and geographic diversification. They're rolling out an ERP system across their firm, which should help them operate more efficiently. And when we look at dividend per share over time, I like this chart because it shows the cash flow from operations and disposals. So like these other businesses, most of them, they're buying and selling companies under their umbrella. And you can see what they use their cash for on the right. See what a small component dividends is? And they're also doing M&A and share buybacks, R&D, things like that, debt reduction, which is good. So there's a lot of wiggle room there to continue growing that dividend over time. That brings us to our next company, Unilever, fourth on our list. So you would all be familiar with some of their brands, which are sold across the globe. These 30 power brands now account for 75% of their turnover, and that's their strategy. They say here, prioritizing investment behind these strong brands. So they provide a great deal of information for investors, and it's quite a lot to digest. I was overwhelmed just by opening up the deck, and lots of new terminology as well. You see this USG, well, that stands for underlying sales growth. It's really just revenue growth. But then you see some other acronyms. You see UVG and UPG. So you have underlying volume growth and underlying price growth. So if volume grows and you sell more stuff, that's great. Your revenues are going to go up, but not if the price goes down, right? So the combination of those two can be used to explain underlying sales growth. I'll show you an example in a second, but this is a cool chart because it shows last year's revenue, so 60 billion, that's a lot, and then this year's revenues, let's say the year before last's revenues, right, year over year. They're declining, though they had 7% underlying sales growth. That's because of currency, right? So this helps explain why they didn't grow revenues. They actually did, but all things considered, they didn't, right? And the inability to grow revenues is certainly something that's probably contributing to their low compound annual growth rate for dividends. So their high 60s expense ratio means they're pulling back on that growth and saying, listen, let's try to grow our earnings per share so that we can have a lower payout ratio and more buffer, and then we'll start resuming our increase. They never had that strong of increase anyway at 6.6%. But this chart here shows how this company is very well geographically diversified. You can see here the various regions. And let's take Europe, for example. So upper right corner, Europe's turnover full year, so their revenues. Underlying sales growth, so growth in Europe, right, was 4.1%. But look at the numbers below that. So volume growth was down 7.7%. People purchased less things. Maybe that's because price went up. Look to the right of that, UPG showing price growth, right, underlying price growth. So prices went up a lot, 13%. And as a result, they sold less. Same thing, right, on a quarterly basis there. So this is all rather interesting. And note on the bottom there that emerging markets make up more than 50% of the revenue. So that's very appealing because that's where all the population growth is coming from. That brings us to the fifth company on our list, which is Bunzl. And I actually had come across Bunzl in my career where I worked at a hub and spoke startup in the food service industry, Amfire. And we were sold to a much larger firm. I was employee number 7, so I got to experience what it was like to wear a lot of hats in a startup. And we worked with Bunzl. They were one of our first customers. And you see here, this is their operating profits. Over half of their operating profits come from North America. That's why we ended up working with them. And then from Europe, you see UK, Ireland, rest of the world. And what they do, their sectors, their food service, so that's where we dabbled in. They also do grocery, safety, cleaning, hygiene, healthcare. You see all these bits. But the takeaway here is that look at these key metrics. So revenues growing consistently over time, profits increasing, and of course dividend per share increasing 9% there over the past 19 years. That's pretty good. But what I found most fascinating was just how many acquisitions Bunzl does. take a look at this table here. It shows their acquisitions for the last half of 2023, and look at the names: Netherlands, Brazil, Canada, North America, Poland. That was their first acquisition in Poland. Manitoba, Brazil. So they're growing very quickly through M&A, and that must be their core competency, that they're able to add companies that quickly and have them add value. So perhaps they run it more decentralized. We don't know. You'd have to dig into that and take a look. But just to conclude here, Linde is a company that overlaps with our core Quantigence portfolio. They're as solid as they come, so they're a leader, and when you look at all their financial metrics, it's really quite impressive. RWS, they could use a deep dive. So it's tempting to say, oh, look, an AI dividend champion. That's hard to say, because it could disrupt them as much as it could offer up an opportunity. And I think that's definitely worth a look in a future piece. Spectris, they do lots of boring measurement and test things across many industries and sectors, well diversified. We like that. Unilever provides more metrics than you can shake a stick at for investors. Expect low dividend growth until their grand plan comes to fruition. And then Bunzl, a very interesting consolidator of companies. As I said, I think M&A has to be their core competency based on how quickly they're expanding using that avenue. So I'm going to go ahead and leave you with another video we did on 5 dividend champions that we're holding, the top dividend champions in our strategy. Certainly worth a watch. It didn't get as many views as I thought it would, so give that a watch. Make sure to subscribe to our channel, and please consider supporting our work by purchasing a report or an annual subscription. Thanks so much for taking the time to watch this today.